More good news on the economic recovery to report, but a crucial period ahead, still with the dependence on the vaccine rollout to sustain the V-shaped recovery. Our latest thoughts on the market outlook for 2021 and beyond. Once again, all of last month's economic data ran ahead of expectations, even with the recent upgrades to forecasts from our Reserve Bank and across the markets in general. The GDP figures out yesterday showed an even stronger rebound going into the new year, over 3% growth in Q4, on top of an upwardly revised 3.4% for the third quarter. The first time on record our economy has gone back-to-back with this level of quarterly growth. Even more pleasingly, the recovery isn't just coming from the housing market and the public sector, it's coming from business investment and exports. And so, the rebound in activity is more broadly based, despite how indiscriminate the recession was last year. This equates to a fall in GDP of only 1.1% from the same period a year ago. So, economic output should return to pre-pandemic levels by mid this year, as long as the vaccine rollout remains on track. It's a vital few months ahead to see how smoothly that process goes, to allow borders to open and remain open, allowing mobility and activity, and to see how our jobs market copes with the end of JobKeeper. All indications are that we're far less reliant on that support today than initially projected. So, the unemployment rate, already back down to 6.4%, and total employment can extend the V-shaped recovery. But this is dependent on the vaccine rollout continuing and on businesses having confidence in the post-pandemic economy. Consumer sentiment and spending is supporting this outlook, as is the remarkably strong property market. Hence, financial markets are now more confidently eyeing off a broad-based recovery, the reflation trade. The RBA have committed to keeping the official rate down at 0.1% for as long as it takes to see a sustainable rebound in inflation and wages. But the markets are implying that this won't take the 3 years that the RBA are saying. The sharp rise in bond yields suggests that cash rates might need to be tightened as soon as next year. It's all a reminder that ultra-low interest rates are here for a good time, but probably not a long time. And borrowers do need to keep that in mind when thinking about fixed rates and making sure there's a buffer to cope with higher interest rates ahead. Stock markets are also buoyant on the reflation trade and hopeful on the economic recovery ahead. But rising interest rates, whenever they're coming, will add volatility to stock prices, especially those more sensitive to interest rates and exchange rates. The Aussie dollar briefly hit 80 cents last week, and this may be the main reason the RBA are so insistent that interest rates need to stay at these rock-bottom levels. But the more the V-shaped recovery continues, including the housing market, the less we need monetary policy support. We're all hoping that the recovery continues, but a stronger economy won't need 0% interest rates. It's a balancing act on all fronts, but Australia's economy continues to outperform, and rising commodity prices are an encouraging sign that this can continue. And that's the market update from Bendigo Bank.